Hey there and welcome. Have you ever stared at a Forex chart, about to click buy or sell, and just thought to yourself, what am I actually doing right now? If so, you've come to the right place. Today we're going to pull back the curtain on one of the biggest questions in retail Forex. So let's get right to the heart of it.
Right? This is the classic question that trips everybody up at the beginning. I mean, when you sell the British pound against the US dollar, it's not like you've got a pile of pounds sitting in your account. So how is that even possible? This is the core mystery we are going to solve together right now.
And our first clue is right here, in this super simple little conversation. Just for a second, forget everything you think you know and look at this for what it is, a simple bet. One person says, hey, if the price goes up, I'll pay you the difference. The other says, you're on. Now, what's really important here is what they're not talking about. Nobody's talking about exchanging actual money, are they? Nope. Just settling up on the difference in price. Keep that idea in your head.
And that simple idea leads us straight to the biggest myth that we need to bust wide open. And that's the idea that when you're trading Forex, you're actually in the business of buying and selling physical currency.
So let's make this crystal clear. The myth is that when you go long on EUR/USD, a little pile of euros is magically transferred into your possession somewhere. The reality? Nah, you were simply making a bet. That's it. A bet on which way the exchange rate is going to move. Will the euro get stronger or weaker against the dollar? That's the entire game. Now there's a fancy-sounding word for this, speculation. It sounds complicated, but as you can see here, it's really not. It just means you're taking a view. You're looking at a price and saying, I think it's going up, or I think it's going down. You're not a big corporation or a tourist who actually needs the foreign cash. You are a speculator. You're making educated bets on price movement.
Okay, so if we're just betting on prices, a pretty logical question pops up, right? Where do these prices even come from? Well, to understand our little world of betting, we first have to take a peek inside the world of the big dogs, the real foreign exchange market.
This is it, the spot FX market. This is where the giant banks, the huge multinational corporations, and even central banks do their business. And here, they are physically swapping massive piles of currency with each other. They agree on a price right now, that's the spot rate, and boom, the transaction happens. You know, the best way to wrap your head around this huge, decentralized market is to just picture a giant, bustling bazaar.
Think about it. When you're in a bazaar and you want to buy a rug, you find a seller, you agree on a price, and you physically hand over your money in exchange for that rug. It's a real transaction. The spot FX market is the exact same thing. Just instead of rugs, it's an American company physically swapping millions of dollars for euros to pay its suppliers.
And this right here is probably the most important thing to understand. You and me, as retail traders with our laptops, we are not playing in that bazaar. We're not even in the same city. We're in a totally different place that just, well, it watches the prices from that main bazaar.
So, if we're not in the bazaar, where the heck are we? Okay, this next analogy is going to make everything just click. So, let's forget about currencies for a minute. Let's talk about iPhones.
All right, just imagine there's a website out there, and its only job is to track the live, real-time price of a new iPhone in US dollars. The price ticks up, it ticks down, all based on supply and demand. Kind of sounds like a currency pair, right? This is what we call the underlying asset.
Now, here's where the magic happens. Imagine a second website, a completely separate one. Let's call it a scoreboard. All this scoreboard does is display the live price from that first website. But, and this is the whole trick, it lets you place bets on whether that price is going to go up or down without you ever having to buy or own or even touch a real iPhone.
Let's walk through it. It's super simple. The iPhone price is $900. You think, you know what? That price is going up. So you place a bet that it'll rise. The scoreboard site takes a small security deposit from you, say $100. Then, you were right. The price shoots up to $1,100. You decide to close your bet. So what happens? The website pays you the $200 difference, and you get your $100 deposit back. Boom. You just profited from the price changing, and you never even saw an iPhone. Okay, I think you can see exactly where this is going. It's time to connect our iPhone analogy directly to the world of Forex, and finally reveal the answer to that big puzzle we started with.
All we have to do is make one tiny little change. We just take iPhone/USD off our scoreboard, and we replace it with EUR/USD. And suddenly, the entire machine of retail Forex just snaps into focus. Because this This is exactly what your trading platform is. It's the scoreboard. It's just a really sophisticated interface that your broker provides. It displays the exchange rates from the real spot FX market, and it gives you the tools to place bets on which way they're going to go.
So you see, what you're actually clicking on, what you're trading, it isn't the currency itself. It's a special kind of financial instrument, one whose value is completely derived from the price of something else. In this case, the exchange rate between two currencies.
The official term for this kind of thing is a financial derivative. And again, don't let the name scare you. It's just a contract whose value depends on or is derived from another asset. That asset could be a stock, or oil, or for us, a currency pair like the euro versus the dollar.
And inside this huge world of derivatives, there is one very specific type of contract that is the absolute engine driving almost all of retail Forex trading.
And here it is. The answer. The whole shebang. What are you actually trading? You are trading a contract for difference, better known as a CFD. That's it. It is a private agreement, a contract between you and your broker. And the terms of that contract are dead simple. You both agree to exchange the difference in the price of an asset from the moment you open your trade to the moment you close it. That's the game.
So, let me just leave you with this final thought to chew on. Now that you know you're not actually trading currencies, but you're trading a derivative contract, a CFD, based on their price, and that contract is with your broker, how does that change the game for you? How does that change the way you look at the market, the way you think about risk, and just the very nature of what you're doing? It's a big shift in perspective. Definitely something to think about. Thanks so much for watching.